Happy Friday, everyone. Thank you so much for being here and welcome to the Real Life Real Estate Investing Show. I'm so glad that you guys could join us live. And if you're watching on YouTube, thank you for watching. For those who have not gotten the memo, my name is Hector Hernandez. I'm a real estate fund manager and wealth coach here at Real Life Trading. My friend, business partner, and most importantly, the winner of 2022's Best Looking Real Estate Investor Award, Luis Alejandro Lopez, is my co-host today and always.
There you go. All right, guys, how you doing? My name is Luis Alejandro Lopez. I'm a real estate investor, acquisition manager, and specialized on home flipping. Flipped, I don't know, a million, but I have almost 200 homes in my career. And I'm also a real estate investing coach here at Real Life Trading. So today we have a great show. We pretty much also what happened with Jay Powell today. So let's talk a little bit about the markets. What's going on with the market? Where is it going? What are the current trends? Are we going to die? Etc. So first, we're going to check the status of the real estate market. We're going to go nationwide, and we're going to focus a little bit here and there locally in different markets. Okay, we're going to touch on current trends. Some places are, busting supposedly. Some places are bubbling supposedly. Some places are going high. Some places are going low. And we're going to touch a little bit about history and things what happened before. Okay, then we will get our crystal balls, shake them a little bit, and try to figure out when Jay Powell is going to raise the rates again. Okay, so this morning we had the market wrecking speech. It lasted probably 5-10 minutes, and we had 2 hours of selling and selling and selling and selling on the market. DJ was really happy when he jumped into Amazon, I think it was. We all did. So, but listening to the speech, we have a few things that were very important. First,
before you get too deep into that, can you confirm you're seeing the speech here on the screen?
Yes, sir, it's there.
All right, perfect.
If you really want to, bring something to your board, bring it to the bathroom, whatever. We went to the speech, and there are a few key things that we need here. Okay, first, they really, really want to bring the inflation down to 2%, no matter what happens. Okay, so they're going to keep putting the pressure. They're going to keep bringing the pain. Okay, and they're going to be probably just having the rates high and higher and higher until the inflation is back on track. Okay, what does this mean? It will be some softening on the labor market conditions. That's what he said. If the interest rate keeps going down, business are going to go out of business. People are going to lose their jobs. It's going to be a lot of pain, supposedly. Okay, there will be a slower growth. He probably doesn't want to have negative growth. He doesn't want to bring us into a nastier, higher recession if it's really here. But the labor conditions are going to soften up. Okay, it's going to bring down the inflation, should bring down the rate of growth of prices, and it's going to bring pain to households and businesses. He said it. There's no way.
In his words, exactly.
Okay. Now, according to him, restoring stability will require maintaining the restrictive policy for some time. Okay, because he says that historical records say that previous Feds have had the rate high, they think everything's okay, they loosen up a little bit, and things go crashing again. So in his words, he's saying that he's going to raise the rates, and the rates are going to be high for a long while. Probably until he gets he gets the inflation back to 2%, which is what it really is.
So how long is the pain going to last, Lou? How long are we being pained for?
Last? Well, according to the projections that he was mentioning, they have the net Fed meeting at September 2023, and they're looking to have the rates just below 4%. Okay, and how much the rates are now? Hey, Hector, you have the screen.
All right, let's take a look. Let's take a look at some funness. Here I am going back quite a bit of ways, all the way back to 65. And you guys can see this is where we were in July. Now, this is a little bit low because this is only updated on the 1st of July. So there was an additional 3/4 of a point hike that came in mid-July. So right now we're hovering a little closer to like 2.2, 2.5-ish. But essentially you can see kind of the historical. So I thought this was pretty cool to bring up. Yeah, I tried that, Thomas. 8. Let's see if actually I'll go to August. Yeah, it won't let me. I believe it's released at the
end of the month.
At the end of the month. Oh, let's see. Did it go? Did it go? No, it won't change. Yeah.
Well, he's hovering at what 2.5 that he has it.
Yeah.
So let's bring
according to bank rate, it's sitting at 2.5 right now.
There shouldn't be any changes until September. However, if he's saying that he wants the rates just below 4% throughout 2023, means that there should be at least 1.5 increase from here to 2023.
Correct. That's kind of the fun part. So, just take a look at where we are now. We're still here. We're actually a little bit higher. We're probably around here, which is 2019 highs. The last time that that they were increasing, the Fed was increasing rates, and Luis and I were heavily invested at the time. And as always, full steam ahead with a bunch of flips and projects and rentals on the market. So we felt this. We felt this pain right here towards the end of 18, beginning of 19, and this is pretty much where we're at now. And he is saying that they're expecting to be just below 4%. So that's about another, like Luis said, 1.5 above here.
1.25. So 375.
Yep.
Okay, so it's just below. That's probably what where he wants to be, and he wants to keep it there throughout the end of 2023. So again, my crystal ball, it's the prime didn't show up today. They probably show up around 5, but I'm expecting he's gonna do another 3/4 of a point in September, another 3/4 of a point or half a point by January, and then leave it there and see what happens. Which at the end, those interest rates reflect on the mortgage rates. Do you have the chart for the mortgage rates?
I do. Before we get off the fund rate, though, if you guys look at what I'm hovering over here, these few years right here look familiar. When we were nice and low, then the market got a little out of hand. They had to turn up the heat, and then it led to a nice big drop in the real estate market, which then, of course, they had to chase down. This was the 2008 recession. The recessions are in gray here on the chart, by the way, guys. So as you can see, this is by no means the highest we've ever been. We're not heading to the highest we've ever been. We've been way higher, way back in the 80s. Now, hopefully, he doesn't have to turn up the heat that much. Let's just hope that we all get the point sometime around 4, 5, and we stop buying all kinds of useful things for our home.
Jason is saying that we will burn if that happens. Well, maybe they, if we're frogs, 1/4 of a point, 3/4 of a point, 2/4 of a point. I mean, it happened in the 80s. I mean, the mortgages were what, 16%, 15%. It was stupid up there.
It's let's just say that it's been worse. Let's take a look at this chart here, guys. And I can throw this in the chart if you guys are not familiar with it. This is Freddie Mac. They are one of the U.S. sanctioned U.S. mortgage lenders, and essentially they are there to keep rates low. They buy mortgages on the secondary market in order for us to be able to afford buying homes. And even with look at this. In 1981, people were buying 30-year mortgages at 18%. So if you're thinking 5.5 is ridiculous, you haven't seen anything yet. Talk to some of your older uncles, aunts, cousins, grandparents.
Just 10 years ago, I bought a house in 2007, and we were talking about 6%. However, the prices were ridiculous, but not as ridiculous as they are now, which is going to bring us to another topic that we're going to talk a bit later about affordability. And
then Thomas is saying that the world would crumble if we went above 10% or above double digits for a long time. And yeah, I fully agree. It would be very, very tough. Exactly. Even over 5% is pretty dangerous if we go too long, which is kind of why we're here to kind of discuss what damage this is doing to the real estate market. Go for it, Lou.
If there is a damage, because
if there is a damage, yes.
If there is a damage, we wait, because things were completely out of control, and now everybody's doomsday, we're going to die, but really we're going back to normal. Okay, ideally, that's of course there's pain, because if you have a house, you bought a home a year ago at the top of the price, another year ago, January, February, of course you're gonna feel the pain. But not everybody bought homes, in the last 6 months. So some people are gonna feel the pain. Most of us have equity in our homes, so shouldn't be that bad. However, what do we have here? That you have the trading rate. If the trading rate goes another 3/4 of a point, like we're looking at probably 6.5% interest rates. Okay. Keep in mind, this is the average 30-year fix for your average credit. And this is, if you find a good mortgage broker, you can beat this rate, or if your credit is not the best, you can, higher rate. If you go, instead of a 20%, you go to a 10%, 5%. This is average. Those rates can vary all the way up to 6.5 to probably 5, depending on the conditions, your property, how much equity you will have, blah, 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 blah. Okay. So Hector, you wanted to take over a little thing about the interest areas that double in price.
Yep, exactly. So as Louis alluded to here, for those who are not familiar, this is once again Freddie Mac's website, and it does give you 3 different rates: 30-year fixed, which is the safest rate that we're all used to buying our homes with. You come in and you have no problems for the next 30 years. Then we have the 15-year, which is a little bit lower, and the 5-year ARM, which essentially
is an adjustable rate mortgage.
Yep, it is. It is
basically.
Go ahead.
That's what hit everybody back in 2008, 2009, 2010. So basically, you buy your home, you have your rate locked for 5 years, and after those 5 years, it jumps to whatever the current rate is, plus a few points. Okay, because of course it's never free. So whatever the rate may say, let's say 3% or 5%, whatever, plus 3, plus 2, etc. They use different basis. Some of them use LIBOR, some use this one, but it will explode on you usually. Usually when the rates are on the way up, as soon as he refis, it's a balloon, and then you have to pay the new price no matter what. So everybody says, well, at that time I'll refi, but if the interest rates are higher than what you had before, then what's the point? Okay. And remember, we cannot predict the future. We can, figure out what we have now.
I think Jason said it best here in the chat. Those ARM loans broke some arms last time around in 2008, 2010. Yes. And that is indeed the case. I've been reading a lot about how much popularity these things have gained in the last couple months, particularly in the higher priced homes, because it makes a massive difference. If you're buying a $200,000 house, 1 point is, it makes a difference, but it's not a huge difference. If you're buying $1 million house, a point is a major difference in your mortgage payment. And they are gaining some popularity now. Like Louis said, it's 5 years fixed, and then every 1 year after that, it could go up to whatever the market rate is. So if you think in 5 years rates will be lower, then hey, it's not a major risk. You're going to essentially get the.
If you think you will move within 5 years,
or if you think you will move within 5 years,
maybe you're buying a home and you're going to be empty nester within 5 years. Why not try it? But remember, just keep an eye open, because things change, and maybe it's not the best interest. Maybe ideally just get a 30 and then figure it out from there. The difference is less. It's what, 1.25, not even 0.10. It's not that bad a difference. For a regular price home, $400,000, $500,000, it turns about $300-$400 a month, more or less. It's not wallet and neck breaking. So keep that in mind.
Yeah, I personally think that the ARMs are more for the savvy buyer, the savvy investor. If you're looking to buy a home, I would urge you to go fixed rate. You're going to pay a little bit more now, but if for any reasons the rates go down in the next couple of years, like some people are predicting, then you refi and you have no problem, rather than it being the other way around. 5 years comes up, rates haven't come down. In fact, they're higher. It destroyed the real estate values, and you got this massive rate increase coming, putting you at risk for losing your home. If you're an investor, if you're savvy, if you have a strong business plan, then it's a different story, because it's a risk adjusted solution. You're making a educated investment, so to speak. Now, before we get into these, I want to bring up some of the doomsday articles that everybody's seeing out there, which is yeah, it's like full.
We're all gonna die.
Oh my God, foreclosures are coming. The pandemic normal. Then housing inventory picks up speed. And it's all these articles. I don't have even the worst ones here. I wasn't able to line them all up. 10 cities where sellers are slashing prices, and all these articles that lead you to think that the real estate market is already in a slump. I'm about to tell you, the slump hasn't begun yet. We might see a slump, but as of right now, the numbers are barely indicating a slowdown. Let's talk about the reason why this has to happen right now, what the Federal Reserve is doing, and why this has been really painful for some buyers. So this is an article by the National Association of Realtors, aka NAR. I will throw it in the chat for you guys if you all want to read a little bit. This is a fairly new article, and essentially, I'm not going to make you all read the article. I'm not going to read it to you. You can read it on your own. But basically, about 82% or 4 out of 5 homes or metro areas, I apologize, in the country saw a double-digit price increase from 2021 to 2022. The average national home value is up over 14% annually, again, from 2021 to 2022. And to 413,000 is the average national price now, which is surpassed 400,000 for the first time ever. This is record-breaking right here. And this all happened again in the span of 12, maybe 18 months, which is brutal. It's extremely tough. Yes, exactly. The South, South and the Sun Belt, it's where it's at. We're getting there.
We're getting there. We have an hour and change. Relax.
Pace yourself, pop some popcorn. We're gonna get there. Obviously, by all of this happening and then now rates increasing, affordability has tumbled. The same way that rates dropping meant that properties were more affordable, and you saw people that were in 2019 qualified, or at the beginning of 2020 qualified to buy a $300,000 house, going out and buying a $400,000 house. Or someone who was qualified to buy a $500,000 house is now stretching when the rates fell below 3, and they're maybe buying $600,000-$700,000 worth of home because the rates were down, which meant that the mortgage payment was more affordable. And remember, your lender is always looking at what you can afford to pay monthly. They're looking at your monthly income minus your monthly obligations. And then they say, well, hey, percentage of that you can use towards your mortgage. And on a monthly basis, as rates have begun to go up and prices are up double digit in some areas of the country, 30% over the last 2 years, it then does the exact opposite effect. And if you were now pre-approved for $500,000, 500,000, now you're lucky to be able to buy $400,000 house. And we're seeing this across the board. While we're mainly talking in this particular show today about residential single family homes and condominiums, it has affected basically all asset classes. I've got a lot of retrading going on with multifamily. Lenders were at 4%, now they're closer to 5%, and so it is definitely causing havoc across the board. And you're seeing essentially buyers go out and have to reduce their criteria with their realtors. They're going out, they're shopping, they were looking for one house, now it's like, oh, sorry, Mr. Realtor, I got to drop that number. And so it is really making things a little bit harder. However, even with all that, we saw some major price increases last year. 10 of those top metro areas, fortunately for Louis and I, were right here in Florida, in the market that we are the most active in. And so that has been amazing. We've gotten very lucky over the last couple of year or two, 18 months, however you want to call it. You're absolutely right. Everybody wants to live in Florida, Jason. And so they have been making us some money. They've been helping us out. It was a struggle at some points to buy more projects and to get into more deals, but we managed to figure out and to snag a few, and those were winners. They were definitely big winners. But check this out. Largest price gains recorded, increase of greater than 25% to Florida markets. I mean, that from a buyer standpoint is brutal. From an investor standpoint, like me, if you already own property, it's amazing. It's home run. Which is why we've been preaching for several months, and everybody that we've talked to when this whole thing started is don't shy away from real estate because you think better times are coming. You could have picked something up 12 months ago and been up 15% on your money. While you were cash flowing. If you bought a rental, if you just left it there vacant, you still made 15% on your money. That's smart though. I wouldn't do that. Some of the winners here in Florida were the Lakeland Winter Park area, and some of the winners in Florida were some of those markets that we were fortunate enough to shift into in 2020. And so we got extremely lucky. Winter Haven, Winter Park, Naples, Immokalee, the whole Marco Island area, Northport, Sarasota, Myrtle Beach, Tampa, St. Petersburg, Clearwater, all really, really good markets that have seen a major increase over the last couple of years.
Basically all throughout Florida, the coast and the central Florida. The I-4 corridor was brutal.
28, 26, 31%. Again, as a home buyer, rough to deal with. As an investor, we're happy. We can't complain. Now, to the part that we all kind of knew already. And this is why, one of the reasons why Thomas Wong makes all the money here at Real Life Trading is because he is in California. The top 10 most expensive markets in the United States continue to be out west in California. And so they saw some pretty decent increases too, guys. 11%, 17%, 13%. That's pretty good, especially when you're talking about, properties of over $1 million. The dollars and cents of it are really, really good.
100 grand just in a year, just sitting there.
So once again, we're all seeing the damage that's being done, but it's kind of necessary. If you see here how much the properties have gone up just in the last 12 to 24 months, pretty much 3 to 4 times the normal rate. Typically, real estate is meant to appreciate anywhere between 3 to 6%, depending on which market you're in. We're in Florida, so typically we appreciate at around 5-6% annually. We're over 14% and close to 30% in some areas. So it's definitely a little bit ridiculous. It has annihilated people's affordability. And so if we see a little bit of a drop, 15, 20%, that's just going to erase 12 months worth of price increases, guys.
Not even 12. That's going to erase till January.
Yeah, maybe this year. So I'm not by any means in the doomsday camp yet. But Louis, talk to us about the national market, because obviously, we're looking a lot at the better markets, Florida and California. What do you see nationally?
Okay, nationwide. I did a little bit of research. You want to pull that Redfin sheet so we can talk about it. Nationwide, what's going on? Every market is having a oversupply of inventory. Okay, now every website, every place that you read, every doomsdayer on YouTube, everybody is saying that we're going into a major recession on the prices, on the inventory, et cetera, et cetera, et cetera. What is going on is now that the prices are starting to come down. we're getting a little bit more supply. So now, according to Redfin, we're getting 10 months of supply, 10 months, no, 10 weeks of supply. Homes are lasting 10 weeks on the market nationwide. Okay, so if they're lasting 10 weeks on the market, meaning that a home is taking about 2 months, 2 months and a half to sell. So what does that mean? You put it on the market, you wait 15 days to get an offer, you wait 45 days to close. Right there is 60 days. That's just 2 months. So the things are coming back down to normal. Okay, so that means that if you had a home, you're trying to sell a home, instead of getting, 29 offers like I did on my house that I just sold, okay, you're gonna get 6, you're gonna get 7, you're gonna get 4 if the house is not really, a great home. What we've seen also is that homes that have slightly problems, buyers that just don't want it. Buyers want, turnkey solutions. They just want to be in and move in, maybe paint a couple walls, and don't have to deal with problems. Okay, we're seeing price drops. Price drops. You have the price drops chart again. We're looking at your test.
There you go.
There you go. Okay. This is medium homes in the market. So if you hover over to what's that? That's about.
So we're right now sitting at 19 days average on the market today. At the lowest.
That means from listing to getting into contract.
Yep.
Okay. Let's move a couple metros. Let's see. For example, what I've looked is the Southeast. Jason was asking me about it. I just moved to Georgia. So let's talk about the Southeast. Let's talk about North Carolina. Let's talk about Georgia. Let's talk about Tennessee. We having a decrease in prices. Okay. Why? We have 2 reasons, and you're going to see the same reasons are going to be for most of the states. First, when we had the pandemic, we have a lot of people, migrate. People left the big cost of living areas and went down to medium cost of living areas. A lot of people like me, as long as you have, an airport close by, as long as you have fast internet and Amazon Prime, I'm happy. I can work from home. I can do whatever. A lot of people thought about that, but these past 2 years, I moved from high cost of living to medium cities. So Charlotte, Atlanta, Raleigh, Nashville, okay? They saw huge increases in prices, okay? But that migration either stopped or really slowed down, okay? We have a second issue there, is that the rent to income ratio, let's say I go in and buy a whole bunch of homes and I keep buying, price keeps going up. The rents, even though they are going up, for example, in Florida, they're insanely high. In some areas, the rents are not keeping up with the prices. So they have the rent to price ratio, okay, is not valuable. Is not, you're not going to get the same income buying a home right now of $400,000 where you can only rent it for $2,500 a month. The same home that was worth $300,000 a year ago, for the same $2,500 in rent. So you're seeing a lot of investors, shy away from the market, looking for really, really great opportunities, but they're not going in buying whatever's on the market, like it happened with this growth. Okay, that's going on throughout the Southeast. Okay.
So let's kind of cover the weeks of supply, Lou, because that's historically been what drives real estate prices, is the inventory. As we all know, we're all investors, we're all traders, and we all know it's about supply and demand. And in real estate, that's measured in months of supply. How many months of supply of property listings do we have on the market? And it is typically, just so you all know, historically, anything more than 5 to 6 months becomes a buyer's market. 5 to 6 months worth of inventory becomes a buyer's market. Anything below 3 months becomes a seller's market. 2 or 3 months becomes a seller's market. And anything below that is just really tight.
And we were seeing 6 weeks of supply.
And so, yeah, exactly. So for a really long time, this year, we were seeing 6 months of supply. If this is particular to ATL, because you asked me to pull up ATL. Yes. So right now we're looking at specifically ATL. Year over year, the supply is up tremendously. But as you see at the beginning of this curve, at the beginning of the year, it was down to 7 weeks. I'm sorry.
And that includes the overall market. That includes undesirable homes. That includes new construction that it's not fully ready. That includes everything that it gets listed and it gets into the Redfin or the NAR charts. Okay, so again, you can list a home that is in pre-construction and it's not going to be ready for 2 months. That affects the chart. Realistically speaking, we all seen it. Things are selling within a week, or we're selling within a week.
Yeah.
Okay. We didn't have to do much effort. Just put a for sale sign, and people will come knocking at the door. What's going on now regarding the other cities is we've seen the locals. So what happens? You got all that influx from out-of-state money. We're going to see the same situation as happening out west. All the influx of people, what Jason is saying, people from New York, Pennsylvania, Jersey, DC, selling their homes really expensive. Those are really high cost of living areas. They sell their home, they bring cash, they come here and they can buy houses cash immediately without having to deal with anything. So that competition was bringing the prices up and up and up and up.
And those buyers are not very concerned about the Fed fund rate, the interest rates, or none of that. If they're
buying cash, or they're buying 50, 60% down. They don't really care. I mean, their mortgage is going to be peanuts. It's pretty much a car payment.
Yeah. Okay. So we're starting to inch up to a little bit over we're about 10 weeks worth of supply right now, which is just a little over 2 months. So we're still in many areas of the country,
still in a seller's market,
in a seller's market, in many areas of the country. Again, if anybody has a particular metro they want me to look up, I'm happy to throw it in here and check it out. We looked at Atlanta. I guess we could look at Nashville, since we got a lot of Nashvillians in the area, in the room. And Nashville's up to 10 weeks. It's inching up there. At the low of the year, there were down to 5 weeks. 5.5 weeks. Tennessee is hot. Yes, indeed it is. And we're starting to see a little bit more inventory, but again, still not at risk of a seller's market just yet. All right, let's see. San Diego. That is a fun one. Let's see what we got.
There you go.
Oh, look at that. Not bad. Hey, they're doing better than Tennessee.
Yeah.
They only have 8 weeks of supply. So you're still in a relatively tight market there, Kelvin. You are pretty low supply. You guys dropped down to 4.4 at the low. I guess the low would be down here, 4.2.
Yeah, first quarter of the year.
And then let's see, Greenville.
North Carolina, there you go. South Carolina. No.
Oh, wow.
Tennessee.
I'm looking at Tennessee. Hold on. But hold on, before we get off this, do we see the chart? Do we see this chart going back down, Louis?
Mm-hmm.
Greenville is still good, guys. Greenville's popping. Look at that. It made it all the way up.
We'd rather not.
And then it's coming back down. So, and a lot of that sometimes is due to the fact of sellers hearing the doomsday news team. Yeah. If you're a seller and you're like, you got an email from a realtor, a letter 2 months ago, and it's the hottest real estate market ever. You're like, maybe, I'll sell. And then you start reading the news that the market is going in the other direction and you don't really have to sell. You probably call your agent and say, hey, you know what? I changed my mind. 1, it's going to be tough for me to find a replacement home. 2, I kind of may have missed my window. So you will see that. And that only adds to the supply problem. That does not fix the supply problem. High prices are mainly due to lack of supply. So that I think will kind of keep us in check a little bit as we go down into the, what did J. Paul call it? The control drop. I forget the words that he used. Somebody help me out, throw it in the chat.
Biddings will continue to
it's not a controlled burn, right? No, that's what they're doing the forestry. Okay, no. Wrong thing. Okay. This is Greensboro, North Carolina. Wow, interesting. It's like Greensboro did not get the memo until the beginning of this year, and then it's when it started to drop. So you are in a very supply constrained market there, Mark. I'm wondering if let's check out another Okay,
But you're looking at Greensboro, he's in
price
Greenville.
drops. I'm sorry.
Greenville. We'll look Greenville, South Carolina. You're in Greensboro.
I guess it helps if I learn how to spell.
Yeah, sometimes.
Price drops are increasing though, even though the market is decreasing there. Okay.
And there's a reason why, because everybody that sells a house, you know, in this crazy market, if the house next door for me sold for, let's say, 300 grand, hey, I want 320 for mine. Hey, I want 350. So people are just listing the prices all the way up there, basically fishing down. They're just setting the bait and waiting to see if somebody, you know, comes in. We're seeing a lot of prices come down,
yes,
a lot of slashing prices. But again, the properties that there was never a comparable sale to that one. People were trying to break the market over and over and over again. That is not sustainable. Now, it was sustainable with a lower interest rate, but as soon as Jay Powell just started raising the interest rate, mortgages went from 3% to 5%. You cannot really break the market anymore. Okay, that's the real situation right now. So we are setting the prices, coming back to where the houses are selling in the neighborhood around. You cannot really, you know, bring a house 400 grand in a 300 grand neighborhood just because you want it. Okay.
The struggle is real here, guys. Can you all tell I'm a real estate investor and not a geographer? It took me a little bit to find it, but I think I got it. All right. So you don't really need to know all the cities in the country to be a real estate investor. I just proved that to you all. Maybe not even typed that well, you know. It's a word that corrects you.
Keep going.
So I think I got it here. Greenville, South Carolina. I believe this is the right one. Mark, Jason, help me out. Tell me if this is what you guys were looking for. And we are increasing. I was very shocked to see that Greenville, there's also a Greenville in North Carolina. There's a lot of Greenvilles. And
yeah, there's a lot of Asheville's, there's a lot of Woodstocks, there's a, you know.
So like pretty much the whole nation, they're sitting at 9.8 weeks of supply. So still seller's market. And it's starting to get to a point where you will see some balance once we cross over that 3-month threshold.
Which is not a seller's market, is not a buyer's market, it's just level. Both sellers and buyers can choose, you know, and of course, if you have the need to sell, then you drop the price immediately and go from there. Or if you need to buy, you know, in a hurry, then you have to pay higher. But usually there is, like he said, a balance where you can, you know, pick and choose. Both sellers and buyers can pick and choose.
And that's kind of the ideal market, where nobody is beating up anybody else. And we might see that here probably pretty soon with the way that, you know, what's the most important part I want you guys to notice on this is the sharpness of this curve. This is what we traders call moon Lambo move. And that is in the months of supply. It is trended up extremely quickly from literally just 3 months ago. You know, it's up by a nice chunk. Right now in Raleigh, we're sitting at 8.6, Jason. So pretty strong seller's market still, once again. Yes, 7. Yeah, nice. Jason's banking it over there. 70%. Love it, man. Congrats. Yeah, I wouldn't be too upset either.
Fairfax, Virginia is not there. Do you have any bigger metro, Mark?
Yeah, I'm gonna need a slightly bigger metro than Mark if you can.
DC, Washington DC, maybe Maryland or DC metro. There you go.
DC comes up. Yes.
Yeah, same thing.
Right up there, 8.8. Again, it's starting to be a little bit of a trend with the heights. It's definitely there was one that caught my eye a little bit ago, so I'm gonna throw that on the screen. And this is pretty close to you, Jason, I think, maybe. Greenville, North Carolina. Check this out, dude. So it looks like everybody who was buying in Raleigh realized Raleigh got too expensive sometime in February and decided to attack Greenville. They had 21 months of supply in the beginning of this year, and it's actually on a downtrend. 12 weeks. I'm sorry. Yes, weeks. And they're actually on a downtrend, down to 5 weeks of supply. So I'm not really sure what's going on in Greenville, Jason, but you should have been buying there a few months ago. And if you find anything there, call me, because we can move it pretty quickly, I'm sure.
Well, that's a push you need, Jason.
There
Make
you
the phone
go.
call.
That's what you got to get in there, man. We're still seeing some price drops, even in Greenville. While we're, it's still a seller's market, we have seen some, a little bit of price drops. Let's take a look at the entire nation with price drops. We're up there, year over year. We're starting.
It's only 3%. Look at it, 3% year over year. But when it grew 20%, what's 3% of the drop? I don't know.
You're still up 17, right? Yeah.
You're still 17% profit year to year.
Yeah, well, it's not that. It's not that, Jason.
I hear you, Jason.
Freddie, man.
Jason is selling that the best thing to do is sell and move to the next market, and then move to the next market. It's like, I tried to do that. It took me 2 years to convince the wife and the kid and everybody to move. I'm sure Jason has the same issue, so it's not easy by yourself.
And Matt, I will tell you. Yeah, it's not hard with a family, but I will tell you, Mark, Matt, that is a very old school and true and tried strategy. Because remember, team, you don't have to pay income tax on the gains from your homestead property. If up to a married couple, I believe is up to 500,000. Again, don't quote me on this. I'm not a CPA.
250 single person, 500 for a married couple. You have to live in the house 2 out of the 5 years, and that's it. You sell it, that profit is yours. Your pocket, move to the next one. I got a good friend that does that. Every 2 years, 2.5 years, he's moving to the next one. He buys, fixes it up nicely. He lives in there 2 years, and then boom, hits the market.
I think we've heard Jeremy say, you buy the ugliest house in the neighborhood, you move in, you little by little make it the nicest house in the neighborhood, you move on to the next one. Now, you could get a little fancy with it, where we've done this in the past. It's instead of selling immediately, again, you have to have lived in it 2 out of the past 5 years, so you could rent it for another year or two, move to your next home, rent it for a year or two, and then sell it. I'm kind of waiting for the best time to do it. You could get very creative, but it is absolutely a solid wealth building strategy and wealth accumulation strategy. You don't have to be a full-time investor. You go doing things little by little. You just have to be willing to be uncomfortable with the move, be uncomfortable when you first move into the property. It's not going to be
rehabbing it or whatever. If you really want to rehab while you're living there, that's the point. But yeah, there are million strategies. You can move in, you can be living in this one, buy the next one, rehab the next one. When it's done, you move, you rent your old one, leave it rented for a year, put it in the market to see what happens. Boom, profit. It's doable. A lot of people do it.
It absolutely is. So let's talk about
days
in the market. Go for it.
Oh, you want to talk the days in the market? All right. So what we're seeing days in the market, that we went from hover up, Metro, all the metros. We're looking at how many days in the market, 29 days in the market, median throughout the country. To how many days now in the market? 19. So yeah,
at the low, we were at 17. So we're still really low, like Lewis was saying at the beginning of all of this.
So remember your schedule. You list your home, you prep, you do an open house, you start getting offers, you select an offer within a week or so. Then you have inspections, appraisals, whatever. You close in 45 days from the moment you sign a contract. So that right there is your 2 months, 45 days to 2 months that your property stays in the market. It's really, really quick. You can select offers basically immediately. It still is a good. So what we're seeing and what we've been talking about is that we're seeing all those doomsday things all over in YouTube, all over the news, all over. And things are not really that bad. Okay, at least not now. We have to wait for another couple increases, and then we'll see. Let's talk about a couple other markets that I have here. For example, Texas. Texas is particular, and they do seem to be having a bit of a bubble. especially in Austin. All right, here's the situation with Texas. Just like Florida, Texas have no state income tax. Okay, but they disproportionately have big portion of their revenue is the property taxes. Okay, which okay, we know that we get a property taxes. If I buy the home for 250, I know I'm going to pay the 250 plus whatever percentage increase year to year. Florida, I believe, caps it at 10% if you are homesteaded. If you're homesteaded, there's cap your home. You can only raise the taxes up to 3% yearly. Doesn't matter the price. Okay. The thing with Texas is that Texas reassess the property values every year. Okay. So what happens when your homes in Texas, in Austin, in Dallas, in Houston, whatever, just went up 60% year to year? What happened to your property taxes? They're going up. They're not going to bleed up. They're going to explode up. So what we're seeing in Austin, we're seeing in Houston, we're seeing in Dallas, in the big cities, is that most of the homes that were bought as an investment, the property prices, the property taxes are going so high that the new bill for the investor, for the landlord, is way too high. The rents went up, but the rents didn't go up high enough to catch on that. So the cash flow that the investors were having got really reduced, or started becoming negative. At that point, what people do? What happens if you have your charge is going up, and starts coming down? It hits your limit stop. What happened? Your limit stop, boom. That's where I want it to be. You list it on the market and get rid of it. So what's going on is that we're seeing a lot of investors putting properties in the market because they're still selling all the way up there. Okay, with maybe a slight drop. And we're seeing a very big increase of properties listed. That doesn't mean that the prices are coming down. They're just, again, fishing to see, what they're going to get. So the bubble it's not popping, but yeah, we're looking at a lot of properties, not flooding the market because it's not a million homes, but we're seeing more homes coming in the market from investors that they're deciding to get rid of tenants. Okay, they're deciding to basically get rid of the property and find better opportunities somewhere else. Okay, so we're seeing that. Well, we're seeing also in the West Coast. We all know West Coast, we just talked about it. West Coast is a very high cost of living area. So all the coastal areas, California, Washington State, Oregon, a lot of people moved out west. Where did they move? They moved to Idaho, Utah, Arizona. So we have also the similar situation happening. Post-COVID move has stopped. Okay, since there's lots of land out west, there's a lot of construction. This is the biggest place, I think, Utah and Idaho were the biggest places, highest construction in the new home construction in the whole country. So what happens is all of a sudden you have that oversupply because people from California, whoever was going to leave, just left already. They're not going, the people that are living there, they're still living there. So you have an sudden oversupply of new homes that they're not affordable for the locals because, again, the prices went up and up and up and up because you have money from out of state, and they have to come down in price to make it affordable to the new, the local population. Now, the growth in jobs in Utah and Idaho is not the best, so the prices are starting to come down. That's what we're seeing. If you see the list in, let's say, Salt Lake City.
Salt Lake, okay.
Yeah.
This is awesome, by the way. When you asked me to pull it up, they're up to 15 months of supply, so they're inching up there.
Yeah.
They're inching up there, and
because Austin is one of the biggest one that grew. Remember,
they're dropping prices.
3 years ago, Austin was like nothing. All of a sudden, it became the new Silicon Valley, Silicon Desert, whatever they want to call it. So Apple moved there, Tesla moved there, a few companies moved there. Prices went up the roof, but if you have to pay property taxes, all of a sudden, 5,000, 6,000, whatever amount, double your property taxes. It doesn't really worth having a whole bunch of homes there. I mean, if you're a landlord, just dump the homes and buy them somewhere else. It's, you need to follow where the money's best at that point.
And you're dropping the 10% of active listings in Austin have had a price reduction, which is, it's inching up there. And like you said, it's people fishing, but it's definitely inching. What was the last market that you just asked me to look up?
We wanted to see Salt Lake City.
Need a bigger market.
Need a bigger market. Let's look for Salt Lake City, Boise, Idaho. Boise.
Oh, Boise, yeah, my boy Robert Falco lives in that area, if I'm not mistaken.
Yeah.
Uh, so 16% of active listings have seen a price drop in Boise as of August 14th. So literally just a few weeks ago. This is up from under 3% earlier this year in March. And then what we're going to do is also look at the months of supply here in Boise. 12,
yeah.
Weeks of supply. So that's 3 months, right? So they're inching up towards a stable,
a balanced market.
Yeah, they're starting to get to balance.
So what does that mean? That the homes are gonna sit there for a while. If you're not the best price, or top, they're not gonna choose your home. So what's the next step? Then you're gonna lower your price. You're gonna start listening to everybody, and then that's the snowballs. That's how they happen. Okay, but at this point, just be very clear, it's not doomsday. We're just coming back to normal. All right. So Hector, how's Florida looking like? We love Florida.
Florida. Let's see. We're definitely starting to see a few properties sell below the listing price, and obviously we're active in the market. I'm constantly on the MLS, as is my wife, and so I'm constantly seeing this. And we've pulled it up for you all on prior shows where people are making reductions. Just like Lewis said, a lot of people were just fishing, throwing up high numbers. Heck, we do that. We just listed one of our flips a couple weeks ago, and we decided to go the way up there, aggressive on the value just to see what happens. And then we did a very aggressive price reduction this weekend. But we knew exactly what we were doing. We were trying to test the market. The last one that we that the video will be coming out really soon, guys, that we sold. I feel like we priced it too cheap. It sold within a few hours. So we figured, hey, you know what? Let's test the market on this.
Let's fish a little bit.
Let's see what happens, because we may have left a little money on the market with the last deal. And it was literally just a few weeks ago. So it is a slightly different top, but nonetheless, one of those top 10 markets that you guys saw on that list. And so we tried. It didn't work. We dropped the price a little bit, a little bit, but it makes sense. And this is what a lot of people are doing when you have a good agent, a good realtor, and you're not emotional about it. The people that get hurt in these types of market are the people that get emotional about making that price reduction. That's right. I'm talking to all of you traders out there. The same way you're not supposed to move your stop and you're supposed to bail out of a trade if you have to, it's not much different in real estate. You want to sell a property to maximize, then you can go fishing for longer. But if you need to sell, then you need to price ahead of the market. And for all of you guys that are aspiring investors or are investors or are realtors, if you have not read the book that we've recommended from our list of readings, Shift by Gary Keller, I suggest you go buy it right now, because this is where we are in right now. We are in a market shift, and in a market shift, you have to price ahead, not with the current market. Go ahead.
You need to stand out either with price or with value.
Yeah, and I would argue that with both. We're still in the very early stages of the shift, so you could literally just stand out by being the nicest house in the neighborhood. But as we just saw, that didn't work out. We literally are the best looking house in that entire neighborhood. We did absolutely everything to it, and our price still needed to be realistic. Where I think, maybe 3 months ago, we would have gotten whatever silly price we threw in front of it. But things are starting to kind of come into a more median market. Here we are, Miami. Check out Miami, dude. 18 weeks.
But you got to remember, Miami, Florida, it's also season of a market. Yes. Right now, August is the dog month for everything in Florida. Everybody escapes the heat. Everybody goes on vacations. So nobody's buying homes in August. That's the other part in Florida. This is not the best time to list. Usually the best time to list there, it's March, April. People want to buy, want to be ready for the next school year. So they want to be settled up by, May, June, so they can go on vacations and come back when the new, school district or whatever they're going to do.
Yeah,
That's
we're still below the average from 2019. I threw 2019 as the blue line that you all see here on the screen, and most of 2019 we hovered in the 30 weeks of supply range. We escalated a little bit, like we said, end of 2018, beginning of 2019. There was a tightening, and we spiked all the way to 45, and then we hovered right around 30. 2020 it's a little bit of a weird.
2020, yeah, it's weird because
it was hard. It's hard to say because it was COVID, and then it spiked over the summer heavily. I remember having properties come online at this time. I turned some of them into rentals just because I wasn't getting what I wanted. And now I'm happy that I kept them. 2021 is just, it's an outlier. We'll look at it for a few seconds here if you guys want, but essentially, we went down to 14, came down pretty steeply. Price drops were non-existent. In 2020, they were like 2%. Right now, we are dropping prices to 3% of the listing in Miami.
That's 25%.
That's not really a lot, team. Not really a lot by any means. And then we look at Orlando. Let me get rid of 2021 again. I mostly wanted to look at what's going on right now. Orlando, we have 8% of properties with price drops, and we have, sorry, I keep clicking the wrong thing. Here we go. 8 months of supply. So Orlando, a relatively tight market, which is, I believe I mentioned it to you. I've been talking to some pretty big teams here in Florida, and that's what they're saying. Orlando's starting to come back into popularity. A lot of the builders, I guess, slowed down a little bit. They're over construction, and so Orlando is holding up quite well. Where I thought with all the construction that we're doing, it might not. It was one of those markets that were at risk, but it seems to be doing pretty decently. Tampa, which is our other hot market here in Florida, 8 weeks of supply, again, really tight. And we are by extension in this market.
Yeah, we're in this market right now.
What's a good market, another market here that we want to look at in Florida? Jacksonville. Everybody talking about Jacksonville. We're up to 10 weeks. And 8% of the properties have price reductions.
All right. You wanted to mention about foreclosures. What do we have in foreclosures right now?
Well, we got started with Florida. So in the interest of not going back and forth, let me finish sharing some of the Florida news, right?
All right.
This is a report done by Dave Ramsey. We all know him. The RamseySolutions.com, and it was a really interesting article that came out actually earlier this month. And basically, he talks about some of the stuff that we just talked about, and all the essentially what we just gave you. 35% year-over-year increase compared only to Arizona and Tennessee. So he did do an update on YouTube not that long ago. Man, I should have watched it. We could have just repeated what he said. But then again, what's he know,
Yes.
And it's essentially, did you catch that? In March, Florida prices shot up 50% higher than national prices. Yeah, it is insane. Like Dave is saying here, it is. He is really a good source, and so not much different than what we basically told you guys. The 20 largest metro areas, Tampa, the Gulf Coast is on fire. People want to leave those cold states, those high interest rate states, and come down here. And if you're going to come to Florida, well, most likely you're going to want to hit the beach. You're going to want to go fishing. And, our Gulf Coast is huge on that. The East Coast also saw some pretty big increases as well.
Actually, Martha just moved down to Clearwater.
As a matter of fact, she did. Marta just moved down to Clearwater.
I think she's in a paddle boat right now. She posted
Yep,
something.
yeah. So she'll catch the replay. Lucian moved down here, I believe last year, if I'm not mistaken. So there's, we're seeing it right here in the RLT team. People are moving down. There's only one person I know that left Florida. Only one.
Can't take the heat no more.
But he left to another pretty strong market in ATL. So it's not bad at all.
I hear you, Jason. 24 years, too much.
Right, Rock? I mean, who leaves Florida, man? Come on now. So, I like his predictions here, so I kind of read them out. They're not my predictions. These are Dave Ramsey's predictions. And this is for 2022. Yes, rates could slow down the price growth, and I fully concur with that. Sales might even go down a little bit, which is basically what we've been saying. And affordable homes will be in high demand. One reason why we've gone full circle right back to focusing on what I like to call the bread and butter properties, those entry homes under $500,000. That grew, right? 3 years ago, it was under 400. Now it's like, all right, now we got to go under $500,000.
Yeah, we usually look on the FHA requirement. Usually,
yeah. So what you typically want to do if you're going to be an investor, you're going to continue to flip, which we'll get to that in a little bit. Just remember affordability. Remember what your target audience is. And the affordable homes, those people that have been saving all these years that want to buy a home, those are going to suffer the least. Those are going to be the ones that are going to be in the highest demand. The smaller markets in Florida will receive more attention, and that's across the board, team. This report is specifically to Florida, but it's not much different than what Lewis just did. Lewis moved to Georgia, but he did not move to Atlanta. He moved just outside of Atlanta, close enough to be able to go there whenever he wants to party or fly somewhere internationally, but he did not move to downtown Atlanta.
The smaller market. There's plenty of smaller markets over here. No, Jason, I moved to Woodstock. So I'm closer to Kennesaw, just north, going to Canton. Towards Canton, 575 is starting to go up to close to the mountains. I'm loving that.
Yeah, and then he mentions here some of the markets that we already saw this increase. We saw Fort Myers is blown up. I know my boy Richie is out there. How much his property has increased in Fort Myers. Lakeland is blowing up, and Melbourne is another really good market out east on the East Coast, and the Panhandle, which used to be called the Forgotten Coast, is making a comeback, team. Once again, it comes down to those slightly smaller markets, while Miami might get less attention. The smaller markets surrounding it will continue to see more get more attention. Buying, selling, Dave Ramsey has some opinions and some rules. I'll let you all check that out on your own. And but it's good stuff nonetheless. Some of his article, continue your plans. And I fully agree with that. Let's take a look at the Stellar MLS stats. So, do you tell me if you see my Stellar stats there on the screen, Lou?
Yes, sir.
All right.
All righty.
New listings are down, which is not helping our inventory at all. It is pending home sales are down a little bit across the board, and the homes sold are definitely down a fairly big chunk here, as you can see. While the days on market shot up in June, it seems like it dropped back down in July. And my guess is that was kind of those people that were on the fence, and then they saw, they are going to keep increasing rates. Let me hurry up and just get this thing done before I rather get a 5.3, 5.5 versus a 6.0, 6.2. So you're going to see that fluctuate, and we might see August numbers come in pretty strong. We won't know, unfortunately, because this data is not released till the 1st of next month. Or actually, like middle of next month is when we'll see it.
I think the 17th.
Okay. Oh, there you go. As of August 9th. So
Right, okay.
that more or less, on the 9th of September is when we'll see August, but more than likely we may have seen a little bit of a crunch of those last minute buyers that are trying to stay under 6% on their rate, and they rushed in and hit the market strong. We're not going to look at Puerto Rico too hard right now, but okay, closed sales. Here we go. This is the one that I wanted to look at. Closed sales is down. It is absolutely down. Just like we said, things are taking longer to sell. And we are soon approaching the 2-month of supply stat, but we are not quite there just yet.
That's a stellar. So that's throughout Florida.
Correct. This shows the entire state of Florida. It's not much different than what we just saw on Redfin. However, Redfin doesn't let me just go to the entire Florida. It let me go to Miami. As you all saw, Miami had a slightly higher number than this. Miami had 15 weeks. So that goes to show those stronger markets are definitely slowing down a little bit faster. This is going to take into account those smaller markets in Florida as well. So it might not look as doomsday.
Yeah, it's not doomsday.
All right, so then let's go ahead and cover foreclosures real quick, because I've been getting a lot of questions in the community. And before we get down to whipping out the crystal ball and giving you all the predictions, let's touch on foreclosures, because you've seen the headlines. I've seen the headlines. Foreclosure activity is up, I don't know, 200%, 100%. Well, when you had 5 foreclosures in 2021, if you have 10 in 2022, it's up 100%, team. But let's look at the data. This Atom Data, by the way, fantastic website for real numbers data. I like to focus on the numbers. I'm not a read people's opinion or watch people's opinions kind of guy. I will listen to all their opinions, but then I formulate my own opinion by reading the data. And here's the data. 2022, we're up to 164,581 foreclosures, up from 65,000 in 2021, down from 165,000 in 2020. Again, 2020 and 2021. Remember, 2020, I believe it was what, June?
2020, they stopped all the foreclosures in April, right after
So not even the middle of the year. So it was going to be a saucy year in 2020. Yeah. It was going to be up there, and they slashed it down. 2021 was when we started foreclosures again. I want to say it was towards the end of the year, but please don't quote me on that.
I think in Florida was in October last year that they started.
So, and I mean, these are national numbers, obviously, but you can see that, yes, we're inching back up, but we're still not at 2019 levels. And 2019 levels is kind of where we got to get back to erase the whole COVID, numbers that just got distorted because of government intervention. So yes, foreclosures are on the rise. Foreclosures are coming, but it does not mean that it's going to destroy the market. We still are really, really long ways away from the 2008, 2009, and 2010, which were over 1 million. Yeah. And that's when things, can really start to get a little scary. The states with the highest foreclosure rates are Illinois, New Jersey, and Ohio, according to the Autumn report here.
And we got to think about quick thing. Let me add up this market is completely different than the market that we have 2007, 2006.
There it is.
We have a lot of people with actually equity in their homes. Everybody that bought it in the last 3-4 years. I mean, the price increase has been amazing. Even if we, like we spoke earlier, even if we drop now 20%, we're just gonna take off the profits or the gains from the last 6 months. So a lot of people still have equity. Different from 2007, 2005. A lot of people were buying with 0% down, with 2 loans. If they take the home, I don't care, I'm not losing anything. So even if foreclosures are gonna start coming up, it's gonna take a while, okay? Remember, in order for the foreclosure to happen, the people cannot pay the mortgage anymore, okay? And they cannot do anything else but to lose the home. In the case of short sales, remember what happened a few years back, is that the people owe more than what the home is worth. That's not happening this time. Okay, so if the things go really bad, if the things start, hurting the market, hurting homes, what's going to happen is we're going to see a bundle of homes coming into the market. People are going to try to sell first, and then we're going to start seeing the foreclosure. So the foreclosure process takes a while to be done. Especially we have states that have to be throughout the course of foreclosure has to be a lawsuit, et cetera, et cetera. So, for example, Florida, it can take up to a year for be able to foreclose a home. That home will be on the market. That will be ready for sale. If it's a home that it has no problems, you're probably going to sell and be done with it. So foreclosures are going to take a while to come back, like used to be 150 properties a day back in 2011, 2012.
The good days when Lewis was fishing, taking out 6 or 7 big old juicy fishes.
Fishing with dynamite.
Yeah, just. All right, so this is the headline that I wanted you all, that I'm sure everyone has seen on there on the news, taken from this report, but out of context, right? Yes, foreclosures are up 219% from last year. But let's look at the chart, team. Last year, they were basically non-existent due to government intervention. So if you're seeing this article, some of this article snipped and shot somewhere else, you could panic. Oh my God, foreclosures 200%. It is still very, very low in comparison. As a matter of fact, if we look at this quote here from Rick, who's one of the vice presidents of intelligence here at Atom, he predicts that with this steady climb, we will get back to pre-pandemic levels on the first half of 2022, which we are, I guess, pretty much there. And then we will get back to normal level in early 2023. So still a whiles away from normal levels. I would say if we're going to go back to 2019 levels, almost double where we are right now. Not fully double, but quite a big chunk more. So yes, there is a major increase in foreclosures coming. They're coming online. That's just from the government intervention that's coming in. Like Lewis said, a lot of people have equity, so I don't yet think that is going to completely destroy the market. Now, what does all this mean? Because we threw a ton of stats at you guys, we threw a ton of updates, and we checked the data live. What I think this means is that it's going to bring about better buying opportunities for us investors, and it's going to bring about better buying opportunities for those looking to buy a home. It is going to definitely hurt some people that don't have the right income or that are trying to buy a bigger home than they should afford. And these are the times when you should be buying less home than you really can afford, because things could get bad with your job, with the economy, and every other, everything else that is going to be hurt by inflation and interest rates, credit cards, car loans, all of that is going to get progressively more expensive. We will continue to do what we do. We are still flipping. We will continue to do so. What I've done in our internal business, and what Lewis is doing as well, is just going back to those slightly wider margins, which we really didn't take down that much. We just took them down a little bit to be able to get more competitive over the last 12 months. We've gone through all the spreadsheets, all the properties, all the backlog that we're going through, and started to increase our profit requirements and decrease our exit price points that we're expecting on properties. To give you an example, I was recently bidding on a riverfront home in the St. Augustine market. We were happy to take it for about 700 grand several months ago. Now I'm down to 6. And I just got the counter offer a couple of weeks ago from the bank. Hey, we'll take your 7 that you submitted back in January. Now I'm like, I'm at 6, guys. Thanks, but you haven't been able to sell it since January, so this guy is not gonna take it at 7. Thank you. So that's just kind of, yeah, exactly. things like Lewis has said this like 8 times during this call, guys. The better homes are going to win. It doesn't mean you can't sell your home if you're just a regular person out there, or if you're even an investor. You just have to do better than you had to do 6 months ago, 12 months ago. You could have listed, we all joked about it, a tent on a lot and sold it for $500,000. Now you might have to tidy up, back to the old school ways of selling real estate, where you gotta make the house look presentable, take some decent pictures. Your realtor can't just grab a picture from
with an iPhone,
or Google.
The street view picture.
Yeah, the street view. What's the best one during the last 12 months? Is like zero effort being put into these listings, and realtors were looking like heroes. And this is what shakes out the winners and the losers. Everybody who thought they were an investor is now about to be met with the facts. Everybody who thought they wanted to be a realtor is now going to be met with the hard work that really is real estate. It's all fun and games until the market shifts, and then now you have to put in work. And it's still fun and games. You just got to work a little bit, and you got to make sure that your final product is there. This is when I think staging starts to come back, Lou. And I know that you're a big fan of staging. We talked to our friend Ben Lapp here in the community, and he loves staging. He stages all his flips. I stopped staging the last 3-4 years. It just wasn't necessary. I was moving the product before I even had a chance to schedule the stager. And staging team, for those of you who are not familiar, is where you basically decorate the property as if someone was living there. Furniture, art, etc. It makes it look homey. It helps you sell it. And it works out, it cuts your days on market. What this also means is that rents are up. So if you buy right, you should be able to buy for cash flow. It is very important right now to trust cash flow. Do not trust appreciation, because at any minute now, the rug might get pulled. Not very different to what Jay Powell just did this morning. Everybody was excited, pulled the rug, market dropped. I haven't seen the closing yet, but I think it was down like 1.5% earlier when I looked. So pretty brutal from where we started this morning.
Yep.
And that is, go ahead.
Those red candles were brutal. The same thing can happen here.
The same thing can happen here. And so if you cash flow, if you buy a property today, if you bought a property 2 months ago, 6 months ago, a year ago, and you're cash flowing and the market drops 50%, you're cash flowing. As long as you don't have a 5-year ARM loan that's coming due, a balloon payment, or you are not able to keep the mortgage obligation because you did not buy smartly and you didn't cash flow, then you will have no problem. You will hold right through it. I know many people that held through the 2010 drop and came and survived and are still holding those properties and are thriving right now. Mm-hmm. So keep that in mind, team. Please use wide margins if you're flipping. Please buy for cash flow if you're renting. It is very, very important so that you can weather the storm. I fully believe, and I have seen a lot of way smarter guys and some of my coaches and mentors predicting this. There will be more renters in the market over the next 2 years. It's just a fact of life. It is now starting to become cheaper to rent than to buy in some places where, it was the opposite for a while. And so that's going to make people want to rent a little bit longer. When you're buying rentals, a couple of tips that I'm going to throw out there. Location is going to become more important than ever. You guys just heard what Dave Ramsey said. Certain areas are going to get more attention than others. But more importantly, the location within the city. So do your research properly on the city that you're buying in, like we've talked about, and make sure that there's job growth. Make sure that there's population growth. And then, okay, now this is a city that I'm buying my rentals in because there's growth here. Well, within that city, you got to find that good school zone. You got to find those good, desirable locations. Mm-hmm. Desirable locations, because your long-term tenants in these areas, in these kind of markets, when you're on the late cycle, you want to buy those size homes that fit the family, the things that cash flow, the things that are desirable. When you're at the bottom of the market, you could buy whatever because everything is going to go up. But now you want to play it safe. You want to buy those better neighborhoods, and all the hedge funds that I know that buy from us have been doing this already for over 2 years. 2019, these guys were already doing it. They were buying the 3-bedroom plus homes with garages. or 2 bathrooms, 3 bedrooms, and a garage minimum carport is what a lot of these guys shifted to over 3 years ago. And you better believe that their criteria is only getting tighter now. So it's not all doomsday out there. Just be smart about it, and use common sense. And if you have any questions, please reach out. Luis, what are your final thoughts? What's that crystal ball say, man? Did it get there?
I don't know.
Amazon pull up?
It's still not here. Super still not here. But yes, please, guys, if you're gonna buy something, just think about your positive cash flow. If you don't get positive cash flow, don't do it. Okay, even if you want to do short-term rentals, long-term rentals, whatever you want to do, just make sure you have positive cash flow. Those days of, I'm going to buy a home and I'm going to pay part of the mortgage, even though if it's rented, because I know I'm selling in a year for a profit, those days are gone. Those days haven't been since 2007, 2008. So be smart about it. Real estate investing is here. Real estate investing is not going anywhere. If anything, we're going to start getting more opportunities. Okay. A lot of people are going to get emotional. A lot of people are going to can't take the pressure anymore, and they're going to start unloading properties. So think about it. Make sure your numbers are tight. Do not fall in love with a property. Fall in love with the numbers. And do we have any questions right now in the chat? If not, we'll close it up.
Well, hey, before we get to questions, I did want to point out that the beatings will continue until morale improves. And by morale, I mean, we get below, like 8% inflation that we're at right now. So, this nice lady here, just replace her face with Jay Powell, and he's the one that's doing the beatings right now.
All right, guys. Well, we want to thank you for joining us up. We hope we enrich your life in any way with this video. If you're live, thank you, guys. I see a lot of attendees here. We didn't drop anybody. I'm really happy. If you're in YouTube, please hit like and subscribe. We have to do it. We want to have, more viewers. We have to grow the real estate channel. Remember, we're always live here each Friday, the last Friday of each month from 2 p.m. to 3:30 p.m. You have any questions, reach out. We're in Slack, we're in YouTube, put a comment, send emails and whatever. We are at reallifetrading.com. You can also go to reallifetrading.com/RE. That's our new website. Everything goes there. We'd like to hear from you. If you have any questions, any comments, any topics that you guys want us to include and research for you, we'll be happy to do it.